All right, so here we are with Chapter 5's bank reconciliation example. So as you can see, the problem is to our left. We're dealing with hotel company here, and it gives us these things that they would find during their bank reconciliation, whether it be from their books or from their bank statement. And pretty much what it's asking us to do is to complete a bank reconciliation. So we know in order to do a bank reconciliation, it's going to take two sides. We need to put the bank side and we need to put the book side. That's our starting point. So there's our starting point. Now, each of those has the same starting point under them relative to where they come from. So let's look at the first one. It says the March 31st balance on the bank statement is $6,874.92. Now, that's from the bank statement, so that would be called our unadjusted bank balance. So I'm going to put that on the bank side. So unadjusted bank balance of $68.74.92. And then continuing on with part one, it says, and the cash balance on the general ledger on that date is $6,026.01. That is from our books, so that would be our unadjusted book balance. I'm going to put that under the book side. So it is important, that's where we start. Every time we do a bank reconciliation, we need to start with the unadjusted balances for the appropriate side. So we're done with one. Now let's go to part two. It says, as of March 31st bank statement, check numbers 1605 for $623.47 and 1658 for $794.82, written in March, so written this month, and check number 1575 for $476.34, which was written in May, so it was written in last month, were not listed among the March's canceled checks. So one thing here is you need to understand, canceled from a bank's perspective means that they've gone through. It's not like where we cancel a check and you know it's voided. It's the bank's voiding. They've gone through the bank. It's made it through the bank. It's affected our bank statements, affected our balances and stuff like that. But these are three checks that have not been affected in our balances. They have not gone through, so they're not canceled yet. So that means that we wrote them. They're still outstanding. So this is just an example of outstanding checks. And typically when you do outstanding checks, you itemize these because you want to keep up with a list of what has canceled, what hasn't canceled, so that way you can look at it month over month. So we know, let's go through our steps. So let's take one step back real quick. What are outstanding checks? Those are the checks that we wrote, send them off to somebody, but they haven't hit the bank yet. Okay, so let's go through our questions that we do all the time. Has it hit our books yet? Yes, it's hit our books because the moment we wrote those checks, we wrote it in our books as well. Has it affected the bank yet? No, because they're still outstanding. So how did it affect our book side when we wrote them down? Well, we made our cash go down. So how do we need to force it on the bank side to make it match the book side? So we're going to make it go down as well. So I'm going to say less outstanding checks. And again, I'm going to itemize these. I'm going to start with the first, the one chronologically, I'm going to start with the first one. So it's going to be check number 1575 for $476.32. The next one is going to be check number 1605 for $623.47. And finally, check number 1658 for $794.82. If I add those up, that's going to give me a total outstanding checks for $1,894.63. That takes care of part two. Now let's go to part three. Part 3 says, while comparing canceled checks with accounting records, it was determined that a check actually written for $237.03 for supplies was erroneously recorded in the records for $273.03. So what happened is we wrote a check for some supplies. And the check that we wrote was actually correct. We wrote it for $237.03. But when the bookkeeper wrote it in our books, they just transposed two numbers. They made it 273.03. And so it's just a bookkeeping error. But with errors, you have to, especially on the book side, you have to be careful. There's a little bit more to it. So I'm going to kind of take you through the steps of this when you're dealing with a bookkeeping error, because this is, like I said, a bookkeeping error. There's two sides to a bookkeeping error. The first side is this dealing with cash that's supposed to be going out, or is this cash that's going in? Now, each of those has its own areas. Because if it's dealing with cash going out, then you're asking yourself the question, in the error, did I take too much out or did I not take enough out? If I took too much out, then the way to correct it would be to add back the difference. I took too much out, so I would add it back. If I didn't take enough out, then I would continue just to subtract the difference. Make sure I took enough out. On the other side, if you're dealing with an error regarding cash coming in, then you have to ask yourself the question, did I put too much in or did I not put enough in? If you put too much in, then you need to subtract the difference out. If you didn't put enough in, then you need to add the difference back. So in this situation, let's go through this. We first know that this is a bookkeeping error. Okay, this is dealing with a check that we wrote, which means that this is cash coming out of our account. So now we're going to the leg that says cash going out. We wrote the check for $237. That is the actual amount that was supposed to come out of our bank. But we wrote it in our books, our cash balance, we wrote it in our books for $273. So we took too much out. So if we took too much out, what do we need to do? We need to add back the difference. And because the bank got it correct, because they got the right check, we need to do this to the book side. So we will say add booking error. And if you subtract the two numbers, 237.03 minus 273.03, you'll get $36. And that's how you do bookkeeping errors. All right, let's look at part 4. It says that the bank assessed a service charge of $25 for the month of March. All right, that's something that the bank does. We don't know about it until we get the bank statement. So has it affected our books? No. Has it affected our bank? Yes, because they just took it out of our account. How did it affect our bank? Well, it made our cash go down. So what do we need to do to the book side to make it match the bank side? We need to also make our cash go down. So we will say less bank service charge of that $25. All right. Bank statement shows the NSF check from someone, let's make up a name, but was deposited in the amount of $763.26. So whoever this person is, they wrote us a check. And when they gave us this check, we wrote it in our books as our cash went up and our revenues went up, or whatever it may be, because that's what we assumed it was. We thought the check was good. But then when we took the check to the bank, they said, you know what, that check's not worth the paper it's written on. So we need to correct it. So has it affected our books? Yeah. Correctly? No. Has it affected the bank? Yes. Correctly? Yes, because it's worth 0 and it affected the bank 0. So what do we need to do to our books to correct this mistake? So we originally, when we got the check, added it to our books. So in order to correct it, we need to take it back out. So we'll say less NSF check or non-sufficient funds check of that amount, $763.26. All right, part 6. During the month of March, the bank collected $3,000 cash on a non-interest bearing note from, again, make up a name. The bank imposed a $50 collection fee and credited the remaining amount to our account. So in this situation, somebody owed us some money. We loaned out $3,000. They owed us that $3,000. It had no interest, so we didn't have to worry about that. And now it was time to pay. And rather than them sending me a check for $3,000, they just went ahead and directly wired it to my bank. My bank received it for me. Now, I didn't know that until I got my bank statement. And in order to do that, the bank also takes out $50 for their work, their hard work in it. So we need to figure this out. So there's two parts here, okay? Let's just focus in on the $3,000 notes receivable that they received. Okay, has it affected our books? No, because again, we didn't know about this until we got the bank statement that said, hey, we received this from so-and-so that they owed you. So it hasn't affected our books yet. Has it affected our bank? Yes, because they received it. How did it affect our bank? Well, it made our cash go up. So what do we need to do to the book to make it match our bank? We need to make our cash go up for the notes receivables collected. So we're just looking at the $3,000. So I'm going to say add notes receivables collected of $3,000. Now let's look at the $50 collection fee. Has it affected our books? No, because again, we didn't know about it until we got the bank statement. Has it affected our bank? Yes, because they just went ahead and took it out. So what did it do to our bank balance? It made it go down. So what do we need to do to the the book side in order to correct it? We also need to make it go down. So we will say less collection fee of $50. Now, is it possible for you to create a single line item for this to just say add NR collected of $29.50? You could, absolutely, and it's not going to do anything. But I like to keep them itemized because it lets me know, hey, I've got to do a transaction or an adjusting entry for each one of those, not just a single one. And so you'll see what I'm talking about here in a minute. All right, let's look at part 7. It says the bank erroneously deducted a $450 check written to motel company from our account. So what's happening here? Well, the bank took out $450 out of our account, but the check was written by motel company. We're hotel company. So it was just a simple bank mistake. It was a simple bank error. They took out money from the wrong account. They should have taken it out of motel company's account, but they took it out of hotel company's account. And so it's just a banking error. And we would call and let them know, hey, you made a mistake here. You took it out of ours. And they would correct it. Given their due diligence, they would correct it over time. But here, we just need to make sure these things are going to match. So we need to force the correction here with the expectation it will be corrected, in the very near future. So this $450, has it affected our books? No. Is it going to affect our books? No, because this is not coming from our books. Remember, this is coming from motel. Has it affected our bank? Yes. Correctly? No, because they took it out of the wrong account. So what do we do? What do we need to do in order to correct this mistake? Well, they took it out. So for us to correct it, just for the purpose of making sure our bank reconciles, is we need to add that amount back. So we would say add banking error of $450. And again, like I said, we would call them and let them know, hey, you made a mistake, and they would fix it. But remember, we want our true cash balances to match here. And finally, part 8, hotel company's monthly cash receipts show a $2,793.46 were deposited, but did not appear on the March 31st bank statement. So we had some checks that we deposited, but they just haven't cleared the bank yet. So these are deposits in transit. And so when we get the checks from our customers, we put them in our books, but they just haven't gone through the bank yet. So have they affected our books? Yes. Have they affected our bank? No, because they're still in transit. How did it affect our books? It made our balance go up. So what do we need to do to the bank side in order to match that? We need to make it go up as well. So we would say add deposits in transit of that amount, and there we go. So there we have finished all 8 parts of the bank reconciliation information. The last thing we need to do for this is to total each side up and figure out our true cash balance and pray that they match up. And so by doing this, you would have true cash balance of $8,223.75 on the bank side, and on the book side, you would have the true cash balance of, the same thing, $8,223.75. That is the first part of a bank reconciliation, but we also know that we have another part that we have to keep up with, which is the adjusting entries for the correct side. Now, the entries, remember when we do entries, we're only doing this for one side. We don't care about the bank side, because the bank side, what we put on the bank side is already in our books. That's why we put it in the bank side. What we're looking for is the thing that we put on the book side, because of the things those that have not been put in the books or we need to correct on the books. So really what I'm looking for are those, 5 entries. We're going to have 5 journal entries. We had 5 line items, 5 journal entries. That's why I like to keep up with the NR collected and the collections fees. That's why I like to do them separate, because I know I've got 5 and 5. 5 line items, 5 entries. So let's just start at the top, the bookkeeping error. So again, this is the last date of the month, so 3/31. It says add bookkeeping error. So add lets you know right away that our cash is going up, which means that we need to debit cash for that amount. So we'll say cash, $36. And then for the credit, remember this was, if you go back to part 3, it says that we wrote a check for supplies. Well, when it was written in our account, we originally, when it was the error was made, we said that not only did our cash go down too much, but our supplies went up too much. We said it went up by 273. It really didn't. It only should have gone up by 237. So not only are we increasing our cash back because of the mistake, but we need to bring down our supplies by that same amount. So we're going to credit our supplies account by $36. All right. The next one, which is the bank service charge. So again, 331. It says less. So that lets me know that my cash is going down. So first thing I'm going to do is I'm going to credit cash, because I know my cash is going down. It tells me exactly where cash goes. If it says add, it goes on the debit. If it says less, it goes on the credit. And every one of these will have cash involved, because that's what we're dealing with. Bank service charge, this is just what we have to pay in order to use their services. So we're going to expense it because we've used them. And so we're going to debit banking expense for that $25. Next one, the NSF check. It says less. So again, we're going to credit cash for that amount, $763.26. And then what are we going to put in the debit? Well, when we put this in the debit, well, let's take a step back. When we first got it, we said cash and service revenue because we gave them the product or the service, whatever it may be, and we put it in as cash, but it's not worth cash. So what's now happening? Well, they still owe us. They still have the product or the service, but we don't have any of the cash. So they now owe us that cash. So we're expected to receive that cash. So because of that, we're going to put it into our receivables account or accounts receivable. So when you're dealing with NSF checks, your debit is going to be accounts receivables because they still owe you. All right, the next one is the NR collected. That says add next to it, so we know our cash is going to be debited. So we're going to say cash of that amount, $3,000. And then the credit is going to be NR or notes receivables because we're getting rid of somebody's balance that they owe us. So $3,000. And then finally the collections fee. So $331. It says less, so cash goes down. So again, we're going to put it on the credit side of $50. And that is going to be another expense because this is what we have to pay in order to use the banking services. So we're going to put that in again as banking expense. It's just another banking expense. Could you lump the two banking expenses together? You could, absolutely. Could you also lump the notes receivables and the banking expense into one journal entry to where it looks like this, where you would have $331, cash of the net amount, which is $29.50, banking expense of $50, and then you have the final NR of $3,000. You can do that as well. Either one of those would work. It's not changing anything. It's just as long as your T-tables are lining up, it works perfect. It's just a matter of to what degree do you want to be detailed in. So, but that's how you do a bank reconciliation problem from start to finish. Hopefully that made a lot of sense to you. I tend to see a lot of students either love this or they hate this because they get it right away or it takes some time. So hopefully this made it a little bit easier for you to get. So, but other than that, y'all have a great one.